Hey everyone, my name is Mawada Basir. I'm a consultant with Deloitte in their blockchain practice. Prior to that, I was the executive director of ColliderX, which is a blockchain technical research hub focused on accessible research, currently an advisor for that. And prior to that, I was at Deloitte doing blockchain consulting.
Hi guys, my name is Amir. I'm a serial entrepreneur investor. I usually say my ADD has ADD. I'm the founder of Block Geeks. So we are an edutech blockchain company. We train government official, Fortune 500 companies, and regular people. And a little funny side note, some people might not know, but I used to be an amateur MMA fighter.
And a Canadian kettlebell champion, if I read that correctly.
Yeah, that too. I used to compete professionally in kettlebells.
Very cool. How do you compete in kettlebells, by the way?
That's a whole different conversation.
All right, sounds good.
Swing them at each other.
Let me see if this thing is even. Oh, there you go. Hello, everyone. My name is George. I'm fighting a cold, so I might not have my usual deep voice. But I'm the co-founder and CEO of a fintech startup called Balance. We're in the digital asset space. For the older folks in the room, for the younger folks in the room, we're doing cryptocurrencies. We started out with this idea of building an on-ramp for the early majority market where you actually get to retain the full legal title on your assets, so they're actually yours. And behind the scenes, we ended up having to build a custodian solution from the ground up. Obviously, this seems to be the hot topic these days. We've built quite a little bit of expertise into that domain, so hopefully I can share some of that insight with you tonight.
Cool. For those that entered the room and missed the last 10 minutes, Jenya Mikhalchenko, CEO and co-founder of Sig1 Capital. We're an institutional grade over-the-counter crypto asset trading desk, and I'll give it over to Leah.
Thank you, everyone. Appreciate your involvement.
Yeah, thank you. So our topic is how to protect yourself in the age of digital assets. So my first question for you guys is, if you're looking to invest in cryptocurrencies, how do you know you're not investing with the next Quadriga? How do you know that where you're putting your money is secure? And at what amount should you be in a retail platform? At what amount should you be looking to do more OTC type trades?
I'll kick it off. I think, first of all, anyone getting into the space should be only investing what they're willing to lose, just rule of thumb. Platforms.
Well, that's a rule of thumb for any investment.
Yeah, exactly. But especially in crypto, given the kind of scary and schizophrenic nature of it. I would say, generally speaking, obviously do all of your research ahead of time, check out the platforms, look at the founders, look at the track record. And I will shout out CoinSquare and two lesser known exchanges in Canada, BitVo and NDAX, up and coming exchanges, and also Newton. Pretty cool. Check them out.
I actually want to throw back a question. I think a more appropriate title would have been how to protect your digital assets in the age of digital assets rather than yourself. You want to protect yourself, do MMA. So I guess the question always comes down to what exactly is the platform that you plan on, using, offer to the user in their user agreement. So a lot of the models that we're seeing in the cryptocurrency space tend to be ported blindly from the traditional financial model, where you typically give someone $5,000 and they buy your assets, mix it in with a bunch of other client funds, and on this other end, you get a database entry that says this is how much we owe you, and we're going to pay it back whenever you want to withdraw. Traditionally, that's a security. A lot of the crypto assets platforms out there tend to operate the same model. So I would say make sure, one, you get the full legal title on the assets that you're buying. Try to get them transferred out to your own wallets if you can, rather than keeping them on an exchange. And if you do plan on keeping them on one of these exchanges, at least make sure that the exchange either uses a proper qualified third-party custodian, or at least has a security page out there with the appropriate disclosures on how those assets are being kept and what are the security guarantees around them.
But as an average user, like if my mom was to do this, she wouldn't know to look for those things. So this is why stuff like Quadriga is really fascinating to me, because I like these stories of how industries learn from itself. And if anyone's ever heard of, I think it's Jeff Bezos, there's a story where He had an employee who butchered a $50 million sale or something, and he called that employee into his office and said, "Do you know why you're here today?" And the guy said, I know, I'll pack up all my stuff. I'm out of your face." And Jeff Bezos was like, I think it was him. He's like, no. You're staying because you just cost me $50 million. This is a $50 million mistake. You're not going to make the same mistake again. And I think that's the really fascinating part about things like this when it happens is, as a space, we have this room. This is my second Quadriga panel. It's a pretty big topic where we are slowly learning through trial and error, which sucks, how to protect ourselves better and which exchanges to look at and which ones to avoid. And now we know if there's one sketchy co-founder, maybe we shouldn't put our money into it. And maybe even if there is no sketchy co-founder, we should, proof of keys. If we have crypto held somewhere else that we cannot access the keys to, that means that, as a new user, I'm learning what that means and how to be better in the future.
I was with the co-founder of Signal not too long ago, if you guys know the private messaging app, Signal. And him and I had a good discussion about decentralization and blockchain. And he struck me with like an interesting saying. He's like, until humans change the way they behave, decentralization and cryptocurrencies won't help anybody. And at the moment, and I'm just going to be blunt over here, for the most part, we are blessed to live in Canada, or let's say North America, United States and Canada. We have a good government, we have good banking practices. So for the most part, none of us over here are scared that our money is going to be seized in the bank. We're not scared the government's going to have a coup d'etat. We're not scared of oppression over here. We're the minority in the world, by the way. The majority of the world lives in some form of oppressive regimes, some form of dictatorship that they can't speak their mind, they can't represent their religion, they can't represent their creed, etc. A classic example is Venezuela right now, which is why Bitcoin is high demand in Venezuela, Iran, China, and Russia, and many different African countries. That being said, these individuals in these countries, they go by a gold standard. And no pun intended, it's literally by gold standard. Like originally when you had gold, you held gold. I do buy gold still today, but I don't get a piece of paper. I'm not a firm believer someone holds my gold. I want to hold the gold myself, the bullion. And so the classic example is own your keys. If you don't have your private keys, you don't own your crypto. And my prediction is, and I know some exchanges, and Shapeshift is going to be doing this, most exchanges, if they don't do non-custodial keys, they will go out of business. This will be standard security practice on exchanges, whether it's CoinSquare, Coinbase. If they don't, they will go out of business. These exchanges will be standard, will be non-custodial exchanges, where you as the individual will own your own private keys.
To maybe add a bit on that, so not say anything about non-custodial exchanges, that's obviously going to be a huge market. I might be biased here because this is the business that I'm running, but I think there's a case in point to be made about third-party custody as well, as long, again, as you retain legally the full title on your assets. A lot of people in this space say that, third-party custodians are security holes. I would like to remind them that so are you. In case you've never lost the password or you've never forgotten, the login to your computer, I know plenty of people that have managed to log themselves out of their own assets. So depending on the amount and depending on, your level of, understanding of the technology, and depending on how comfortable you are with doing self-custody, there might be a case in point be made about, find a third-party custodian, make sure the proper legal arrangements are in place, make sure you know what happens to them if they run out of business, make sure you know what the management team is, and maybe hold the bulk of your assets there.
Can I get a show of hands? How many people in the room know what I say or what I mean when I say a cold wallet?
That's good. Wow. Impressive.
Very cool. So for those who don't know what that term means, could we give one of you just to talk about the differences, like just from a very high 101 level of the differences of hosting your assets on an exchange versus a cold wallet or any other alternatives therein?
Sure. So warm wallet connected to the internet. This is a very simple heuristic. Warm wallet connected to the internet, cold wallet not connected to the internet. So warm wallets, Jax, anything on your phone, Mycelium, whatever, Blockstream's new wallet. Cold wallets, Trezor, Ledger, Cold Card, OpenDime, things of that nature.
Is Samsung's solution that you referenced earlier a warm or cold wallet, or do we know?
TBD. I actually haven't touched it or played with it, and I'm sure all the specs haven't come out yet. But I would suspect, since it's on your phone, which is connected to the internet, it's probably a warm wallet.
Just to add a bit on top of that, not only do the wallets have to sit offline, we also need to make sure that the keys were generated securely offline to protect yourself against, out-of-band attacks and all that kind of fun stuff. And also, they're managed offline for the lifetime of the key. So anytime you want to actually access the funds, you need to follow some form of offline transaction signing flow where, using some read-only part of the wallet or some master public key, you generate a raw transaction, you take it to the vault, sign it there, come back with a signed transaction, not with the public key, and you can broadcast the transaction to the appropriate blockchain and have it recorded in the ledger.
Awesome.
It reduces the attack vector a lot. It doesn't fully extinguish it. So the cold wallets are not the be-all, end-all, but they're a good place to start if you want to secure serious amounts.
If you want to go real cypherpunk, use a Faraday cage.
What's a Faraday cage?
I'll let you guys Google it.
A microwave.
Great. So let's shift the topic a little bit. Like anything in finance, regulation is going to be really important. And recently we've seen some new proposed regulations in Ontario. So wondering if you guys can give us your take on those regulations, if you think they will help the industry, if they're what we need, and if you think they're going to hurt or help innovation.
This is a thing where regulation, specifically within the crypto space, because it's so new and young, and the space isn't defined. When I mean by early, like Bitcoin's coming up, it was 10th year last year, so it'll be 11 this year. We're still in the first line yard of a football game. We have a long, long, long way to go. But the difference is the open finance capabilities of this tech, for example, with Ethereum. Like right now in Ethereum, I can take a loan out on DAI. I don't need permission from anybody. I don't need any credit union telling me anything. I can go and put down my ETH and get as much DAI as I want and get liquid 24/7 anytime without anybody telling me I can or can't. That being said, this opens up global regulatory arbitrage, right? So what Ontario does, OAC, or what the SEC does, sure, it limits people within those regions. But with this technology, I don't think so it's going to be as easy as dealing with stocks. I don't think so it's going to be easy as dealing with other commodities. And so it becomes very complex and convoluted. I'll give you an example of two regions in the world. You have Switzerland that say, hey, everything's legal. Utility token, ICO, whatever you want to call it, by all means. Same with Singapore. SEC comes out, or the OAC comes out and says it's not illegal, right? I'm like, I don't give a shit. I'm off to Switzerland. Right? So it's going to be a game of cat and mouse. It's going to be regulatory arbitrage.
But what I think the regulatory frameworks that are coming out really opens up is the ability to actually enforce it. So that's why when you look at exchanges, what some lawyers will tell you is use an OTC or an exchange that is based in a jurisdiction like Canada, because we have strong contract law, we can actually enforce it, and that's where these regulations will come into play, is if I want to do business with a lot of money, the more money I'm going to spend in exchanging for crypto, the more likely I'm probably going to research the shit out of what I'm doing. Well, I'm going to look at companies that are based in jurisdictions where I know that if they screw me over, I have a court of law that I can go to, and I can try to get as much of my money back or get the guys behind it in jail. So that's the good part of regulations, is it does open that door for stronger enforcement of contract law.
So I'll just jump in real quick just to contextualize the conversation around regulation. I mentioned in my presentation that the CSA and IROC put out these proposed new guidelines, and they're specific for marketplaces, so what we consider exchanges. And the open question there is, does IROC and CSA, who typically govern securities, do they have jurisdiction in crypto, which is, to the best of our understanding, kind of a commodity so far? And that's an open answer. No one knows where that's going to go. But there's a few interesting caveats there. One of which I'll pass off to George shortly around custody. But there's one specific thing. Actually, I'll touch on what Moawad said about enforcement. The the regulations matter only insofar as the regulators are capable of providing enforcement action for those laws, right? So OSC and IROC and all these guys can come out with, XYZ regulation. Here's 10 steps that you should follow. But if there's, not a significant amount of staff or there's not enough people to enforce those things, then those things don't actually matter. And that's just me putting my cynical hat on. The second thing is, what a lot of people don't know is Quadriga was actually a registered money service business. They were technically regulated, right? So, and look where that got us, right? It didn't really mean anything. It was more of like here's a stamp of approval, and we'll go off on our merry way with pooled wallets and not segregated wallets for each user, and we kind of have this mess that we're in now. So the regulatory question has a lot of nuances. I don't think it's a blanket statement. But one of the things that I do think is actually useful for people that don't want to custody their own keys, which for the average person, you probably don't want to do that, or some of us are just not capable of memorizing a seed phrase and hiding it somewhere, in multiple locations. The custody thing is important, and I'll kick it off to George to get into that.
I mean, not to poke a stab at Quadriga here, but I'm pretty sure when they were remitting money to clients, they were doing it in a proper regulated fashion. The part where they messed up was the custody. We don't lose the assets, which isn't covered by FinTrack. Now, look, regulation is obviously a touchy topic. The important part, here's what I want to do just to establish a bit of a common ground over here. So first of all, we need some regulation in the space. We can agree and disagree on what the regulation should be, but without, there's a finite set of business models that can, through which you can do some, get profit in your business and run a viable business, and there's an infinite number of scams and Ponzi schemes that it can run. So without any sort of regulation in this space, the free market would effectively push legitimate businesses towards adopting scamming practices, because otherwise how are you going to compete with the guy that tells you they're going to get 25% guaranteed return week over week? So we need some regulations to get started. Now, to further clarify, what the Canadian Securities Administrators jointly with IROC published, not this Thursday, the one before, is an open consultation paper. The title does say proposed framework for regulating crypto asset trading businesses, but it's an open consultation paper. It's the start of a conversation. There are 22 questions, open questions listed at the end of the consultation paper that are open to the public. The timeline is short, May 19th. They'll most definitely get an answer from us. And I encourage all of you to, start engaging and becoming part of the process. There's only 3 answers listed on their site. So if a year and a half from now, some actual proposed regulations get passed through Part 1 of Canada Gazette, there should be no reason to complain if we engage them early on and make sure that our voices get heard, and we participate in all the roundtables and feedback sessions. Obviously, now to come a bit to the point and make this specific, I'm only going to take 10 more seconds. Custodians were obviously the first ones to get, hit out of, out of this whole endeavor. There's one line over there in the consultation paper that says that they might require custodians or any type of platform, whether they do self-custody or work with a third party, to effectively pass through what's called the SOC 2 Type 1, SOC 2 Type 2 report or an auditor. Obviously, that's a barrier to entry because a lot of auditors aren't necessarily willing to engage with businesses and start completing those assessments and producing those audits. But it's a really large net in the sense that saying that a custodian piece needs to have a SOC 2 Type 2, it's kind of like saying you need a cybersecurity audit on your code base. Well, what am I building here? Is it a 60-line Python script, or is it the Linux kernel that I'm doing a cybersecurity audit on? So the scope of those reports could be really large in size or really small in size. So nothing to necessarily get scared. My advice to all of you is to just read through the consultation paper, provide feedback. This is what we're going to do at Balance.
How would one do that? So if someone was interested in consuming this paper and providing their feedback, where would they go?
So
what would they search?
The paper is live on OSC's website. I mean, if you Google proposed crypto asset trading, framework consultation paper, I think paper is 21402 or something like this. But you'll find the link. It's been everywhere out in the news. If you go to their website, you can see the list of consultation papers at the very end. Start providing answers, hit submit. Obviously, they're public, so just be careful with what you submit there. There's supposed to be, feedback for them to come up with a framework, not comments on a cat photo on Facebook. So just please be respectful, but do start engaging with them and make sure that whatever they come up with is something that we can all agree that it makes sense for the industry.
Let's go subjective with this one. You are all experts, and your subjective perspective is very key. I think more meaningful than what might just be inherently true or obvious. What do you guys think? Do you think Ernst & Young are going to recover any of these assets, or do you think they're gone with the wind?
Hard no. I just don't see how. There's just no access to these assets. Like the best guess that they have, actually Jesse Powell from Kraken said a couple weeks ago or last week, he said the best hope that any of the users affected by the Quadriga hack have is for the assets that were moved from Quadriga to other exchanges to be traded. If those exchanges are able to track those assets, that is literally the best chance that anyone has of recovering the value that was lost. And that's a long shot. So I'm going to go with hard no, and it's extremely unfortunate, but it is what it is.
I'm a little bit of an optimist. Well, there was a report a few years ago in, I think, Denmark, where the Denmark police actually found like 30 criminals that were transacting with Bitcoin, and they were able to do it. I think Chainalysis helped them with it. I forget, but they were able to find those 30 criminals. This is just a small, European police force. They were able to do it. I don't know if EY will be able to do it. I work for Deloitte, so I have to be a little, on the other side there. But I think, some of it at least might be recoverable. We've been able to do it with less resources, so I'm hoping that with more resources and the spotlight on this event, we'll be able to get more out of it.
I'm just going to use some common sense heuristics here. Quadriga, they were a great exchange at the beginning. They're one of the originals. I don't want to poo-poo on them. Without them, many companies would not be here today. People have a very short-term memory, and I do want to give a round of applause for what they did for the space. Now, common sense-wise, if you look at it, what happened most likely was they grew too fast during the ICO boom. Too many users went on there. They realized they don't have liquidity. I'm just guessing. And then they became a fractional reserve system. And so it was a pyramid scheme. It wasn't even a set up pyramid scheme. Just that's how it happened. And so the whole notion of there's money in the hard wallet, no. I don't buy it. I don't buy there was a penny in the hard wallet. There's no money. There's never money there to begin with.
I'm with Amir on this one. So, the money is gone. We can probably figure out where it went.
Yeah, but just another layer on top of that, even if you found out using Chainalysis or whatever chain analytics tools you want to use, even if you found out the exact address that it went to, unless you can, triangulate that to an identity in a bank account and a geographic location, you're not.
Which they have been able to do. They have done that in the past.
Sure, but on this scale, I personally think it's a lost cause and it's really unfortunate. But I will be very happily surprised if they're able to recover anything.
Let's have a bet. Let's put in the smart contract. Let's do it.
Will you custody for us?
On the upside, way less
We'll
Bitcoin out there.
Augur,
we
man.
lost those.
Prediction market. I'll put 1,000 ETH down right now.
2,000.
So in absence of the consumer taking control of their assets, what more can exchanges in this space be doing to protect consumers?
Proof of keys, someone mentioned.
Well, simple thing. Okay, so there's basic security practices exchange can do. It's like cold storage multi-sig that's been around from Bitcoin. Like one of the original things what Bitcoin did was a smart contract multi-sig. It's like nothing new, but they don't do it. So it's like standard security practice that they can do. It's already here. Just got to apply it.
But it's also just good business sense. Blockchain's not that, crypto isn't that special. Every company out there has to have proper internal controls. Every company out there has to, get some kind of cybersecurity compliance done. What these companies shouldn't think of themselves as special. The technology is there for them to do it. But really, I think people just need to stop thinking they're special and think, I run a business. I have a obligation to my users, my consumers, and my investors. So I'm going to be smart about the money that I'm holding and operating with. And so Deloitte actually does these SOC 1, SOC 2 audit reports and stuff. And our risk partner always tells this great story of this one crypto CEO that he visited, and he was like, okay, how do you protect your keys? Where is your company's crypto? And they're in this guy's office, and he's like, oh, right here. And he just opens his desk drawer, no lock, nothing, and pulls out a Ledger wallet. He's like, it's all here. That is ridiculous.
And the consultant goes, yoink.
But that is ridiculous. Like you run a company with X amount of users. You have, I don't know how much money in investors and ICO or VC, whatever it is. And you have your crypto on a little, plastic USB in your desk drawer in your WeWork space. Dude, get serious here. Like, what is this? So really, it's these crypto companies that, this is a wake-up call that we're not special. Just like every other company out there has to manage their funds, manage their assets properly to secure their users. We should do the same.
Yeah, don't do what Equifax does.
I think kind of a lesser understood point is just to have like a business disaster and recovery plan. This is something like normal companies do.
Succession plan.
So in the case that your CEO has Crohn's and goes to India to build orphanages and happens to pass away, you can have some sort of backup plan.
Yeah, multi-sig.
And a multi-sig. And proof of reserves on your exchange, which is a service that's easily offered by Blockstream and others.
The reality of the space is, these assets exploded kind of overnight. And all of a sudden, those USB sticks and those Trezor wallets became a lot more valuable than people were expecting them to be. Whenever I pitch my business to someone that's outside of fintech altogether, it seems to them like I'm selling flat water. It's like, what do you mean? Like a custodian solution for digital assets? You don't have that yet? Like this is their their perceived reality from being completely outside of the space. Cold storage with a multi-sig is the start. Not pooling in all the assets into one set of wallets is another no-brainer to do as an exchange. Say you don't have the operational capability to maintain fully segregated wallets for each individual client. You can at least take your cold storage wallets and split them across, say, like $1 million buckets. Whenever I see one of these exchanges with a public key that holds 180 million in it, I kind of get a bit of a shiver down my spine, because I know that by definition, the moment you put those assets there, you've exposed yourself to a potential attack. So there are fairly easy, processes and controls that you can put in place to increase the security of your assets. At a theoretical level, the situation becomes a bit more complicated when you have 30,000 users on your platform, and you're running it, and you have a lot of 3 to 5 years of technical debt behind the scenes.
I'm going off script here, by the way, so everyone just bear with me. How do you guys think that the institutional custody of these assets will change this discussion, if at all?
Well, I think this is also a subjective question, but I'll jump in and kind of provide some context based on some of the institutional discussions we've had. For example, there's a very big asset manager we spoke to in Canada who is very interested in the space. They're crypto curious, as we'll call them. They understand it to some degree. Their customers want exposure to it. They get it. They only need half the pitch. The other half they've already filled for themselves. But the issue is, Trezor and Ledger and even a cold storage multi-sig is not enough for them, right? They need someone that is a qualified custodian, that has insurance, which is a huge piece for big money managers, and basically a trusted financial institution to house those pieces. So basically the stack for a custody solution is proper tech, insurance, traditional financial institution. That's the opportunity, RBC. So honestly, like unless those things get kind of stacked properly and offered as a product, I don't see personally a lot of big funds and a lot of the money managers moving into the space because they need that element of trust even in this trustless ecosystem.
The way I see the space changing a bit once there are proper custodian solutions out there. You can only mitigate risk up to a certain point. Past a certain point, you can only improve the security, so to say, of your customers, either by insurance or by having a financial institution with a large balance sheet that can, effectively backstop it in case something stupid happens. Because of this, it doesn't necessarily make sense to have 25 custodian solutions out there in the market. So there will be a handful of custodian solutions that will actually make sense, backed by the appropriate players. Probably you can start building a clearinghouse so you can clear and settle transactions on top of it. And then the model will change a bit where you won't be having these exchanges and platforms doing self-custody or working directly with a custodian, but rather they would act as an investment dealer that then uses the clearinghouse, which uses the custodian to actually clear and settle once they've done the execution. This is closer to the traditional model of trading securities. And, in broad strokes, this is kind of what the open consultation paper that got published describes for a lot of these crypto assets trading platforms.
Great. Why don't we open up questions to the audience? Anyone have a question?
One-on-one questions are very much welcome and wanted.
So my question is for Amir. You said that security tokens are not as easy to deal with as stocks. Maybe you want to just expand on that a little bit?
Well, in its current form, yes. Okay, so you and I want to start a startup. I need 2 pages for my term sheet. I'll go to my investors. I get wire transfer to my bank, 10 million, done. I've done this in 10 hours. For an STO, you know how much paperwork I need to do for STO? You know how much money? I need 100K off the ground for legal stuff. Then I'm going to figure out the keys. I'm going to figure out the tokens. So in its current manifestation, it's not a value prop for me raising money. And I'm only raising money from accredited investors anyways, right? So it's not like it opens up more opportunities for people. Now in the future, for security tokens to truly have its unique value prop compared to you and I want to do a term sheet, it has to be 100% native. Meaning, like, let's say right now in its mode is like you and I have our shareholders agreement, and fuck, man, sorry if I'm swearing. My shareholder agreement for all my startups change almost like every 6 months. A brand new startup, new advisors, new investors. Some people leave. It's not like it's set in stone. Like it's probably like 6-7 times my shareholder paper changes. Who's counting these changes to my STO up there? Who's responsible for that? Who's responsible for all the shares and changing on my paperwork to go online, right? There's so many different, it's very difficult, and this is why it's hard to merge Web 2.0, like offline, to Web 3.0. It has to be 100% native. And there's companies like, I think Open Banking or something in New York with T0, they're working on like 100% native. I can get my term sheet online, it's not physical. My token is made within the term sheet. Everyone's blockchain address is in there, so it's easy. But we're early, man. I think we still need another 4 or 5 years. Then the regulation issue is like what the OAC does over here is completely different than I do business in Guangzhou in China, in Hong Kong. They don't have access to my STO. They're not accredited. Then you don't get that global. There has to be a global definition. Actually, to make things easier, accredited investor status must disappear. It's a scam. It's a horrible system that makes rich people richer. So my mother can't invest, but she can go and spend $1 million on Lotto 649 or go to the casino and spend money. But God forbid she invests in my startup. It's a complete scam. So for STOs to properly work, all these accredited investor things need to disappear.
Hi there. The question is for Genia. Congratulations on SIG1. And
Thank you.
I'm just curious about the conversations that you're having with clients. Are they Bitcoin 101? Are they sort of more technical, like tell me about miners, tell me about this, tell me about that? Or are they, we understand now, here's my money, go get me Bitcoin?
Yeah, so there's no blanket answer. I would say for the most part, a lot of the clients we deal with are already well educated. They're already transacting, moving around large amounts of both fiat and crypto. But I would say there's like for certain people that are just starting to take their initial steps into the space, I think now and certainly for the next few years, there's still going to be this educational gap that needs to be filled. It's inevitable, especially if it's your first purchase, and certainly if it's your first big crypto purchase. Like if I'm dropping, $100,000 on a Bitcoin purchase, to invest for some years down the line, I want to understand exactly what that is. I want to understand, the history, the system, the players, this, that, how to store my keys, where to custody it. You want to know these things, or any rational person would want to do that. So I'd say there's kind of this dividing line between people we already transact with that understand all the tenets of this kind of ecosystem and all the technical stuff to back it, and there's a second half where there's some education required. But honestly, you can kind of like lead them to the water. Like, here's some resources, you can read it yourself. Like, I don't have to like handhold anyone, because thanks to companies like BlockGeeks, we have a gigantic surplus of information where a few clicks and you can actually understand this with any sense of curiosity.
Sorry, we have a microphone. We have a question over here.
So we've spent a lot of time about keeping your private keys and trying to solve this problem that Quadriga made. So the question I have is, does BlockGeeks have anything to handhold people into multi-sig or stuff that they could just sort of sign up to a BlockGeeks website and be able to learn?
We have a bunch of free guides on that
Okay.
already. Yeah, if they just go on there, they can type it into the search bar and they can find all the free guides how to store crypto.
Okay, so because what I find is a lot of people put up their hands when they said that they know how to cold store and stuff, but when it comes to the reality of it, to be able to understand that wallets are for what you keep in your wallet, exchanges are for exchanging, and to be really able to store what you want for the long term, you need to understand how to store your private keys or to cold store, and that is missing among a lot of people. So I'm not saying everybody here, but it needs to be understood. And
I agree, but before you even get there, I think there has to be a conversation with the individual themselves to acknowledge the responsibility that they have. There's that saying, I'm a comic book geek, with great power comes great responsibility. It's from Spider-Man.
Agreed. So
it's like people need to acknowledge the fact that if you want to have the freedom of crypto, specifically Bitcoin or like Ethereum, Monero, and Zcash, you're responsible for the safety, you're responsible for keeping your crypto safe. But this gives you the freedom to transact anywhere you want. Like, we work closely with, we have people here in you know them from Lendre, Mauricio, yeah. And people are using Bitcoin today to, imagine like, my family's from former Yugoslavia, war happened, money disappeared overnight, and you had nothing. It doesn't matter if you had $1 million or $10 million in the bank. But right now in Venezuela, you have people are literally remembering their seed phrases in their mind, 24 words, and crossing the border with money.
exactly.
Like, this is remarkable.
Yeah. Agreed. So I didn't really put out that question as a challenge, but what I'm trying to tell people is it's your responsibility. If you've got a lot of money invested in crypto, remember this. Wallets you keep in your wallet. Exchanges are for exchanging. Don't blame anybody else if you've left a lot of money on exchanges and then the exchange goes down.
I think people need to be more angry at Equifax. I'll bring it up again. No, I'm serious. Like, twice, that's the ones that we know of, and your SIN number, people understand, like, your SIN number is no joke.
Yeah.
Like, it's I can't believe it. Like, it's crazy.
So
Like, it's crazy.
if I may, just to make it really specific and to the point, if you want to go down that route of doing, like multi-sig with your own kind of tooling, just because you're using open source doesn't necessarily mean that it's safe. There could be very easily, some bug or some exploit, you're going to find yourself locked out of that money or the fund's gone in 6 months while you're sitting in that cold storage. So just really practical, simple, tips. Verify the identity of whoever signed that binary. Verify the integrity of the software that you're using. Most software developers publish some form of SHA-256 or some kind of checksum out there for you to check. So at least go through those preparatory steps. If there's something to remember out of this whole deal is, if you do your own self-custody, make sure you know who signed it and what you're using.
My question's for Jinya. Do you really see a lot of interest amongst existing broker-dealers to sort of work with IROC or apply to IROC to get like a license for being a broker-dealer in crypto? So essentially, they would say, okay, I'm already dealing with, let's say, equities or, fixed income instruments. And for all the tokens which are not which get classified as securities, I would need a broker-dealer license to be able to deal with them. Do you see that a lot, at least with your own experience in TMA?
Yeah, good question. So just to clarify, so IROC regulates companies that deal in securities. As far as we understand at this current juncture in time, the crypto that we deal with, for the most part, it's treated as a commodity. So you don't actually need to answer to any regulatory body under that structure. What I will say is, this seems to be coming up more frequently in conversations about broker-dealers, entering into the space, and it's typically within the context of security tokens. And the reason obviously being because security needs to be regulated by IROC. But I think to Amir's point, as much as I want to be optimistic about security tokens, usually, the metaphor that I give is like security tokens are now where Bitcoin was in 2011. There's very little infrastructure. There are almost no exchanges trading this. There's very little demand. The upside you get with a security token outweighs all the cost, time, and basically all the effort that's spent to create it. So while there's certainly broker dealers looking at it, there's not really, there's not much activity going on beyond exploratory type stuff.
Thank you.
All right, I think we have time for one more question before we start losing people for the evening.
Yeah, I have a question. So my name is Jordan. I'm a partner and VP of sales at BitBuy, digital currency trading platform. And one thing that George touched on regarding the CSA and IROC proposals regarding custody sort of stood out to me, and I wanted to get your thoughts, George, just a little bit more on what you thought, because right now, when it comes to custody, you have huge companies in this space, whether it's Kingdom Trust in the U.S., BitGo, you have Knox out of Montreal, and they're all entering this space to basically, it's a land grab for crypto custody. So they're growing their businesses aggressively and so forth. And now you have the CSA and the IROC proposing these new regulations around custody, whether it's in SOC compliance and so forth. So where do you see it heading for digital asset trading platforms like BitBuy and other ones in the space regarding custody and these proposed regulations here in Canada, whether they're going to have to then shift their custody towards other third parties, or if they're going to be able to continue to have the opportunity to custody assets on behalf of their customers by implementing certain SOC 2 compliance and other procedures.
Makes sense. So, okay, just to start, first of all, the regulatory definition of a qualified custodian that's outlined in National Instrument 31103 basically says that in order to be a qualified Canadian custodian, besides the tech and liquidity and all those, you need to be a scheduled bank or an IROC dealer or a trust with 10 million in free equity on the balance sheet, or to be affiliated with one of those. So the current state of the market is, as far as the Canadian landscape is concerned, none of these digital assets custodians, us included, at the current moment in time, meet that regulatory definition. So, I cannot go to Fred over at 3IQ and say, how about, we refile for the mutual fund and use this as a custodian, because it wouldn't pass and there's not necessarily appointed. Now, obviously there's a land grab of who's going to be the first regulated custodian in Canada. I would want to point out this subtlety that even if some of these digital currencies such as Bitcoin and Ethereum have conclusively been determined to be commodities, depending on how you run your operations behind the scenes within your platform and how you fulfill the trades and the orders for the clients or whatever you're doing with those assets, the vast majority of the models that I'm currently seeing being operated in the market would still fall under the definition of securities dealers. And if that's the case, and you're a security dealer, in Canada, then you're under the jurisdiction of whichever securities regulator, operates in your province. In which case, you will most likely want to, if you do self-custody, make sure that that's functionally independent, from the rest of your business, even if the management team is shared, or better off move to a third-party custodian. Most likely it would be easier for everyone, in the space if there would be such custodians available in Canada rather than have to go to the States and work with Kingdom Trust that has, a trust charter from South Dakota. And there's all the extra disclosures required and, that I have to do over there. So hopefully we're gonna soon start seeing some of that business being brought home rather than being lost out of the border. That's my take on it.
Okay, very cool. I know everyone's getting a little weary for the night, so we're going to wrap it here.